The price of gold over the past several years has been moving higher and higher and higher. All assets have been moving as such. Look at the stock market, look at gold, look at all these financial instruments, crypto. Perfect example. I have been buying PAXG, which is a crypto one-for-one exchange for gold that's being held on account in London. I just keep it in my wallet. I have a specific wallet for that. I'm obviously sitting on some profits. I don't have a huge position, but I want to continue to grow this. Two things, however. First, inflation very likely to move higher and higher and higher, which would push gold prices higher, which would push my crypto holding value higher. I want to continue to buy more, but I'm also afraid that in, say, 2 years' time, over the course of a couple years, we're going to see this inflationary process kind of die down, and we're very likely to see asset prices fall. So I'm trying to, in the future, build up a bigger position with that, and I'm going to use GLD ETF and GLL ETF. And as anybody who follows my content knows, what I do is I usually front run a specific event, economic event, and we'll get in front of that with a certain trade, knowing that there will be price movements. I'm going to take those profits, buy more PAXG. So GLD ETF is an ETF for gold to go long. GLL is the inverse, and it's got a little bit of juice in there that if GLD ETF were to move down, GLL would move up at a higher pace. This works perfect for me. Unfortunately, GLL has a very low volume by like 1/100th. Nonetheless, my profits from that, I'm going to actively, over the next 2 years, positions here, there, pull those profits out and buy more PAXG, the crypto. So let me break down what I'm looking at with gold, the price of gold, and GLD, the ETF, and what you can do potentially with GLL ETF. Should we see any movement downward in these assets, such as the stock market, gold, and all other assets, even crypto for that matter, given what will happen with inflation? Let's jump in. All right, here is a look at GLD ETF. And GLD ETF is actually a really great barometer for gold itself. They kind of move almost nearly 10-for-1 ratio. This one will come in at, about 250 right now, versus gold itself roughly about 2,500. So this is it's a good 10-for-1 ratio to the actual price of gold. They will move hand in hand. And as you can see, and I put this chart all the way back to 2019, it's moved up considerably, like double in the past 5 years. But if you look at the money supply, that has grown exponentially. The Federal Reserve is currently in the process of reducing its balance sheet. But at the same time, commercial banks are increasing loans in a fractional banking system. Because of that, those two things are not crossing themselves out. The commercial banks are actually outpacing the decline of the Federal Reserve's moves. At the same time, the Federal Reserve, by reducing its balance sheet, they are also letting long-term interest rates roll over into the regular market. So anything they might have been holding, they're letting roll over. They're no longer stepping in and buying large quantities of U.S. debt, which by them inventing money and stepping in, other institutions didn't sell off something else to buy this debt. Now, by the Federal Reserve reducing that, this is one of the reasons, and there are a few, that long-term interest rates are moving higher. Trump's policies, not exactly disinflationary. Rolling over the tax cuts will add to the deficit. So you have the Federal Reserve not stepping in and buying more, and in fact, having to have U.S. institutions or foreign institutions step in and buy this debt. At the same time, there will be more debt. And I do have charts on the debt and debt to GDP ratio, so you can take a look at that. Then The real problem could be that with Trump's tariffs, this effectively will slow the economy down because personal incomes is a zero-sum game. If there's a tax on consumption of products brought into the country, that tax would pay for, of course, the deficit created by the rolling over the tax cuts for corporations. The tax cuts for corporations, they're already there. That's already present. So we're not going to see any real jolt from that. We will see a continued increase in the deficit because of that. But then once you start taking money out of consumers' pockets with a zero-sum game, that means less and less revenue for companies. And I think that's one of the things that people are like, they look at, oh, tax cuts is great for any economy, always. That's a bumper sticker. You need to ask certain questions. What kind of tax cuts? How is this going to affect? So I look at the deficit and I say, that's a big problem. So I have been moving into gold, but I've not actually been buying physical gold. Again, PAXG, Paxos, and I keep it in my wallet. It's a one-for-one swap. These assets are being held in England. All right, so this is GLD ETF. And as you can see, the price of gold has been moving higher. Federal Reserve is likely, based on the economy that we could have in the next 2 years, they'll keep interest rates a little higher for longer until the economy starts to slow down because of consumer demand diminishing by having to pay more in taxes. At that point, the Federal Reserve is likely to lower short-term interest rates, and the money supply would continue to grow in that regard, and that's probably going to be inflationary as well. So I see gold as a pretty solid investment looking forward. I think the Federal Reserve is going to have a real interesting balancing act going forward with this economy. For some period of time, the economy will be able to hold on to this, but eventually it's going to wear out. I'm looking at a 2-year time period. How much trading can I do on either GLD ETF or GLL ETF? This is the inverse ETF. If gold goes down, GLD ETF goes down for any reason, GLL would move upward. Inverse. And vice versa. GLD ETF moves upward, GLL moves downward. Most of my trades are there's usually two kinds of trades. I will look to sell options out of the money if I expect nothing to happen. I've been looking at GLL ETF 1 month puts thinking, there's got to be some juice in there. The spread that I've been seeing is 0 at 75 cents for like $15 puts. There's no joy there. There's just not enough volume. So I'll be playing GLD ETF more so. And in that case, I'll be selling calls on GLD ETF. And my attitude is basically this. I don't expect anything to happen. I don't expect assets to continually move higher. If you look at the stock market, the Dow, S&P, or QQQ, all of those, the Santa Claus rally is gone. It's about 50-50-50 with the Dow itself is below the Trump bump. I think S&P 500 is at the Trump bump, but NASDAQ is still holding on to the Trump bump. And that probably has more to do with your sort of legacy stocks versus tech. Tech's a little overjuiced at this point, but not by much. Still, it all boils down to the economy. What is going to happen with growth rates with the GDP moving forward? So in this case, I don't see assets moving much higher because there's really nothing going to be there. And Trump is really going to put a shock into this economy with tariffs. Mr. Market doesn't care about, he's the greatest president ever and his policies are awesome. Mr. Market actually looks at every single detail and says, no, that's not going to work out. The economy will slow down. Is it good overall? That's an opinion Mr. Market doesn't care about. I see GLD ETF peaking out with equities. I don't think we're going to see these highs for some period of time. But at the same time, is Trump really going to do his tariffs? Some are trying to, in his organization, are trying to downplay it as much as possible. It's just a negotiation tactic where he sits there and turns around and says, no, it's not. I'm doing it day one. I think they're downplaying reality. We'll see what happens Monday. Day one starts Monday. We'll see what happens. Regardless, even if that does not happen, the Federal Reserve needs to keep interest rates higher for longer and may have to pivot based on economic data. Look at the jobs report we just got on Friday. This is going to continue to push the economy forward more and more because of the manufacturing boom we're seeing. We're seeing a big growth in that, which is great because we lost it all in COVID. So we're seeing a reversal on that. The commercial bank loans continue to push money supply higher and higher and higher. This would push the stock market and, of course, gold prices higher and higher and higher. But the deficit is really kind of the big problem. Would the Federal Reserve have to pivot? Well, Trump's tariffs are really going to sort of determine that. All right, U.S. 10-year Treasury yields. This is the yield itself, and as you can see, pushing higher and higher and higher. Ever since the reality of the Trump presidency coming into play, I think it was roughly in September that there was a big shift backwards. That two things. Number one, this economy is very strong. Federal Reserve is going to have to keep interest rates higher and higher. I've been saying for a year and a half now, this economy is too strong. The Federal Reserve cannot be moving interest rates. They did anyway. Now we're looking at this data points saying you might have to pivot and go right back around. But it really depends on what Trump does. Because Trump could save the Federal Reserve from having to take action, because Trump would slow the economy down. Higher interest rates is a tax on everything. Mortgage rates. The housing market will begin to slow down more and more and more because mortgage rates are pricing people out. We need to see about a 5.5 on the mortgage rate to really get that thing amped back up. Car loans, higher interest rates, less loans. Simple as that. Here is the U.S. federal debt, the actual debt. There were two big bumps, the financial crisis and COVID, on a per GDP basis. And let's take a second, look at that, and move forward. U.S. debt to GDP ratio. We're at 122%, 1.223. If Trump implements his policies the way he says he's going to do, I think he pushes 1.25 easily, may push to 1.3, could go as high as, say, 1.4, 1.5. And that would be disastrous for the U.S. economy. But I think we easily surpass 125 to 130. That is inflationary. Long-term interest rates will remain higher for longer. Costs will continue to rise. Consumption of housing, cars, things like that will slow down. Then if you factor in these tariffs up front, there will be slower growth in revenue because consumers are being taxed. So this is kind of important to look at. I mean, we cannot go on forever and ever and ever, period. Now, I do want to point out that there has been a period in history where we were pretty much here. If you look all the way down at the bottom, you see 1940. There was kind of an event there that really forced the U.S. government to step up and increase expenditures, World War II. Unfortunately, this particular chart, that's the beginning of this chart, and we don't really get any kind of information on this chart. I don't know what World War I did, the Great War. But on a debt to GDP basis, two things happen. Number one, on a whole basis, the U.S. government spent less and less and less on a percentage basis, more and more and more as time went by. At the same time, the economy itself expanded more and more and more. We had a huge boom through the 1950s when America was great. we're not seeing that kind of growth, but we are seeing big growth in expenditures and debt by the government, and that's why we're seeing these big bumps. Now, Clinton, if you look, just before 2000, he actually was able to have a surplus during the tech boom. But then the tech pop, we see it kind of reversed. Then when Bush left office, he left kind of a big mess. Obama's economy, given the financial crisis and 2 wars, it was tough to keep up with all this stuff. And so debt to GDP rose from 60 to well over 100, a little over 100. Then COVID. Ideally, I would think, ideally 20 to 50%, in my opinion. A reasonable amount. We are so unreasonable, it's not even funny. And this is something that I continue to look at, because what happens is the Federal Reserve has to keep pushing and pushing and pushing. And so many people keep being left behind more and more and more. And that does not add up, especially with a population that just is kind of checking out saying, I've got no future. And there's less and less and less of them showing up. So how do we pay more and more debt? Here's a look at GLD ETF one last time. I'm going to look at GLL ETF again in just a second. But I'm thinking like 260, selling calls, pulling in just a little bit, and then say the next 2 to 4 weeks. My policy on this is we've peaked. And whenever I see, say, consecutive bars, this I think is the weekly chart. The weekly chart. When I see consistent moves higher and higher like we're seeing in the past 3 weeks, it's a little too much. People will start taking profits. There's nothing that's really going to drive this at this moment, given the economic data we have. But of course, let's see what happens starting Monday. Will Trump step in and do what he says he's going to do? If Trump does pull the trigger immediately, I will pull the trigger going long GLL. The nice thing about GLL is its price kind of low, which means you can buy more and more. Again, options, you might be able to get this week's at the money options if you're looking to protect yourself, like maybe buy some at the money puts while going long the underlying, give yourself an insurance policy. But the bid spread on the long dated out of the money, a style that I like to trade, I didn't see the juice that I'm looking for. Now, this will be ongoing for me. I'm going to be hitting these trades for some period of time. I'm looking at 2 years, every week, stepping in. Can I make $1? All right, if I can make $50 over the course of the next week, and then another $50 the following week, that's $100. If the price of GLD were to drop down to say 150, 175 from 250, because the Federal Reserve did have to move in, because the economy contracted and assets kind of came downward, I've nearly doubled my money at that point, or my position size, even though the price has come down. So that's kind of how I'm looking at it. I'll take my profits and I'll buy some PAXG, the crypto for gold itself. Ongoing. If you're interested in following my trades, I'm going to start putting more and more in my notes up on my Substack account there. You can follow me on my Substack, and by doing that, all you get are the notes. I don't think you get the email. You can subscribe to the email as a free subscriber, and it's going to be a weekly thing. I'm going to try and make Saturdays my send out my email day. And it'll be a weekly thing where I'll talk about the economy, things like this. There's 2 levels of subscribing to the emails. Of course, the free subscription, which you're going to get a bullet point of what I'm thinking at any particular time with a sector, plus the video links. Then the premium, which you guys are supporting me. Thank you so much. I certainly do appreciate that, because that continues the content coming. I did announce yesterday that this was what I was going to do it, and there was a big rush to followers on my notes in Substack. Thanks so much. I really appreciate that. That will continue to grow, and it'll continue to create a community as well. Make sure to hit the like and follow button on these videos. I'm going to be putting out a lot of content this year. We are in a big transition. This is time to make money in the stock market.